Hello guys, welcome to session number 7. You might notice I have a rather strange body position, and that's because I'm using a mouse just here with my right hand, and we have a new setup here in the studio which confounded me for a second. Welcome to P2 Corporate Reporting. My name is Martin Jones and this is the London School of Business and Finance. This, as you know, is the interactive product, and up over there on my left hand side is a chat space for you and I to interact. But hang on, let's just see what we're doing and what's going on. Well, I'm going to go mini-me first of all, suck myself down into a corner, and there over my left shoulder appears proof that you and I are working on ACCA P2 Corporate Reporting this evening. And as you know, I like to go right back to the beginning and remind ourselves what we've done so far and where we're going from there. So there is the first session, basic groups, which moved to complex groups, and then we were into foreign currency. We had a look at cash flow statements and current issues, those crazy current issues with the ivory tower articles that I'm hoping you're keeping bubbling over. And then we got into the real financial reporting with performance reporting and provisions, and moving on to non-current assets. And tonight we're going to pick up leases, and these middle chapters, which feel like kind of grown-up financial reporting rather than the rocket science that you get at the end of the course. These subjects in the centre, they seem to have grown in importance over recent years, the last 2 or probably 4 years. The examiner has upped the significance of subjects like leases and downed the significance of employee benefits and share-based payments. I mean, he's probably right, really. I mean, share-based payment and employee benefits play a part in corporate reporting, and they are fancy, advanced financial reporting, but whether they should be examined in detail in every exam, I think probably not. And your examiner seems to have taken that view as well. So what I've done is I've squeezed those two on the basis of, recent examinations. So we're doing 3 chapters tonight, which sounds horrendous. It's not nearly as bad as it sounds, but you definitely will be finding that I invest the majority of my time on the leases, and these 2 fellas over my shoulder here now, employee benefits and share-based payment, will be squeezed into the last hour, which is about right for them. They do come up, but we've got exams now once a quarter, haven't we? And I would suggest you'd be seeing employee benefits once or maybe twice a year, and share-based payment once a year or less, which really, does squeeze them. And both of them around about the 2 to 5 mark point. That's really, that is pushing these 2 subjects into the margins a little bit. Not absolutely into the margins, but I guess I'm inevitably comparing this with the history of the subject matter. Share-based payments 10 years ago would have been a regular and would have been as much as 25 marks. So it's really gone down since then. Okay, so that is a little introduction to what we're doing today. What I think I'll do before I start formally is have a look at my highs. Hello guys, we have a busy evening tonight. I can see plenty of chat going on. I wish you a good session. Let's start. So we're starting with leases as usual. I have my paper class notes in front of me to help me through. So I'll find the page that way first of all. There we go. Onto page 133. Where's the pen? There it is. And I will bring up the class notes over my shoulder. There we go. And I'll even drop in the numbers. I'm going to use a 3 and a 3 there and press enter, and off we go to the chapter on leases instantly. That's nice, isn't it? And let's have a look at how leases work. So off we go down into the notes on leases. There are 2 forms of lease accounting, and the 2 forms of lease accounting are based on where the risks and rewards lie. And really the game with this is to do with the risks and rewards of ownership. Either they lie with the owner or the user, as you can see. What about if I do a bit of highlighting to highlight what I'm saying here? So the risks and rewards of ownership, they either lie with the lessee or the lessor, and that gives different forms of accounting. But as you can see just at the bottom of the page, this subject is really all about bashing numbers. Let us bash some numbers together. Now, before I go any further with question ABMN, I would like to run ahead a little bit just to show you that this is a question with 3 parts. Can you see that? It's got part 1, part 2, part 3. Just feel a bit more comfortable if I can show you where I'm going with this. So let's have a look at question ABMN. Off we go. I'm going to use my usual mode of communication, the pen. And straight away, even in the title, we have a fairly odd bit of financial reporting jargon, and that is in advance. What does this phrase in advance mean? Well, it's to do with leasing, and leases, if I'm honest, they usually have monthly instalments. Not always, but usually have monthly instalments. And there's 2 different timings within the month that you can have the cash flow. It's on the first day of the month or the last day of the month. And the culture is to describe that as in advance or in arrears. So first day in advance, last day in arrears. Now, although leases are traditionally monthly payments, monthly instalments, actually that increases the complexity of lease accounting quite substantially, and not usefully either. It starts to become, a whole science in its own right, rather than just part of a larger syllabus. So what the examiner doesn't do is he doesn't do monthly leases, he does annual leases, where you get the idea of lease accounting without having to be a specialist lease accounting guy. Lease accounting guys tend to be specialists, they tend to specialize in lease accounting. So rather than forcing us to be specialists, the examiner allows us to be generalists, and we do annual payments. This one in advance. And off we go. So the question says, ABMN has the following lease contracts where instalments are paid in advance, A and B. So we've got contract A, contract B. And what we're asked to do essentially is come up with the PPE and the liabilities for this. So the PPE cost, the asset cost is 800 for A. The life is 4 years, so the depreciation would be 200. Gosh, this fellow's really wobbly. That's very weird. 600, I have to keep hold of the screen to stop it wobbling. Goodness me, you can't see that I don't think, but wow, that is wobbly. Very distracting. I think there's a new desk in here. And on the right hand side we have 700 and 7 years, 100, giving us, coincidentally 600 as well. So as you can see, lease accounting for the PPE is easy peasy. The challenge is in liabilities, and this is so because liabilities is split between the current element and the non-current element. And that genuinely does make the subject much, much harder. So we're going to generate a total liability and split it on the balance sheet between current and non-current. What I like to do here is I like to call my unwinding table by the timing of the cash flow. Seems to work for me. Generally speaking, when you're doing any of these stories, capital instruments, all sorts of things, the cash flow is actually in arrears, if I'm honest, in most stories. But with leases, the cash flow could be in advance or in arrears. It could be either. And because there is two different timings to the cash flows, I like to reinforce that with the word advance. So I start at the beginning of the year and I end at the end of the year, and then I drop the instalment in where the instalment goes, which in this case is there at the year end, and then the interest fills the gap. And it's a standard unwinding table. You'll recognise this from the chapter on provisions. We've got interest and instalment, and the only thing that happens is the two I's just swap around depending on whether you're in advance or in arrears. So in contract A for year one, I owe the supplier 800 for my machine on delivery, and then the following day I pay the supplier 220. So for the majority of the year I owe 580. Can you see that, the difference between those two? 580. So if I owe 580 for the majority of the year, I've used 10% throughout these stories to help us out. 10% of 580 is 58. And that 58 is added to the 580 to give 638. 638 is then what I owe. And that 638 is the total of what I owe. And that total comes from the table. And then all I do is a perfectly reasonable thing. I look forward to tomorrow's instalment, which will be another 220. And obviously that 220 is well within a year. So that's the current element. So the current element is the instalment. Which is a figure of 220. 220. And I get 418 as being the non-current element, and that, as you can see, is just calculated as a balance. I'll just give you a split second to have a go at contract B. You have a go at contract B for year one. Off you go. See if you can split the liability. I'll catch up with you now. So in contract B, a machine worth 700 is delivered to me. I then pay an instalment in advance, which means very shortly after delivery, I pay 112. So after paying 112 and for the majority of the year, I owe 588. 588 gives me 58.8 in interest, and therefore that's roughly 59. So 59 added to 588 is 647. 647, and I split that using the 112. So we get 53535. And if only that was all there was to leases, then leases would be a piece of cake, would it not? The trouble is with leases is that you get instalments in advance and you get instalments in arrears. That's what's the problem with this subject. And you have to remember how to do the split, how to play the game. So to help us to learn this process, we have another question called question ABMN in arrears. Actually, I need to get the part there. Yeah, part 2. And we've got contract M and contract N. And we're going to do the PPE for these two babies. Well, the cost of the machine in each case is 500 on one side 650 on the other. And the life of the contract on the machine is 5 years and 13. So depreciation is 100. And over there, 50. Giving us 400 and 600. And therefore a closing carrying value as given. And as mentioned before, you don't really get called a hero for having worked out the closing PPE. But you do need some heroics to split the liability. And I think what I'm going to do is come clean. I'm cheating. I've done this question before. And I've got a little bit of wrapping around my head currently. When in arrears, you do 2 years. When in arrears, you do 2 years. When in arrears, you do 2 years. I can't stop it going round and round and round my head. When in arrears, we do 2 years. Let me show you what that little mnemonic that's driving me nuts is doing, is saying to us. Like I say, I like to call the table by the timing of the cash flow, so I'll call it an arrears table. It is just a plain old unwinding table. Oh, I made a mistake up there. Goodness me. Oh well, come back to it. No comments from you guys. You must have been all happy. You must have been listening to what I was saying rather than looking at what I was writing. Interesting. See if you can tell me what my mistake was. My mistake is not in the numbers or indeed in what I said. It's just in what I wrote. So, instalments can either be in advance or in arrears. And when they're in the arrears, they're at the end. But I've given the game away already. When we have instalments in arrears, we do a counterintuitive thing. The contract that I'm going to do is contract M. And of course the year that I'm in is in year 1, so obviously I want to do year 1. But what I'm going to do is I'm going to do year 1 and do next year as well. But why would you do next year? Well, let's just do it and see what happens with next year. So in the first case, in M should I say, I take supply for 500 and I literally pay nothing for the whole year. So the interest accrues on that to the tune of 500 multiplied by 10% gives me 50. And then the instalment happens at the year end and is a figure of 130. And that gives 550, 420. And what I owe is 420. And because that is what I owe now, you would think I would just stop there and forget about next year. What does it matter about next year? Next year is next year. Well, let's just do it anyway. 420. You do next year. Work out next year's interest. Of course, next year's instalment is 130. And therefore you get, what's that, 462, 332. And what you say is quite reasonable, but different to what we said earlier, which is, when you're in arrears, you do 2 years. You know that the total that we owe is 420. But we also know that when we get to the end of next year, we will still owe 332. We owe 420 and we will still owe 332 of that in 1 year's time. So that must be the long-term element, 332, and therefore we can work out the current element as a balancing figure. There we go. So the formula, as you can see here, is very different. Oh, goodness me. Lost the ability to spell. Balance and table. And before we go back to contract A and B, see if you can do contract N. Have a go at contract N. So off I go. So what was I doing? I was taking delivery of a machine worth 650. I was paying absolutely nothing. The interest was 65. That gives me 715. And then I pay, what do I pay? 70. Which takes me down to 645. 645 is what I owe at the current year end, but I want to know what I owe at next year's year end, not because I'm doing next year's balance sheet, but because of a special reason. So 64.5, you can round that up, round it down, whatever you want to do. 70 gives 639.5. I slot both of those in. 645 and 639.5, and therefore I do indeed have 5.5, which you had 1,000 years ago. Brilliant, brilliant, brilliant. And everything that I said earlier in terms of the numbers was also right. However, the narrative I got mixed up. And as you identified on the chat, but were unable to help me out because I wasn't seeing your chat. I was on a chat on another channel. I had these two mixed up. So rather than pretend I could use some fancy board rubber to get rid of that, shall I do that? Well, I suppose I might as well. I've got fancy technology. Get rid of those fellas and get them around the right way. The logic of what I was doing was perfect, but the narrative at the top was wrong. When instalments are in advance, they're first. There we are there. And then the interest comes after. And as you heard, I managed to actually do it correctly, ignoring my own headings. So one of the things I said actually was I like to have those two words to reinforce the ideas of the cash flow, and then completely messed it up. But I do. You can see I can mess this up. How long have I been doing this? 1,000 billion years. And, you know, the reason I like to call these advance and in arrears is to help me get this right fella at the right point. And even with that assistance, I still managed to get it wrong somehow. But that is the idea of those labels. I'll just say that again because, you know, I don't know. Well, if I suppose if I can get it wrong, maybe you can get it wrong, but maybe it's just a me thing. Maybe you would never get this wrong. But I got it wrong. So the reason I put in advance is to help me put this in advance. The reason I call that in arrears is to get that at the end. And as you can see, everything's looking cool now. Hang on, Martin. That's just a whole load of numbers. You promised me that you were going to talk about lease accounting, and all I can see is a load of numbers. What lease accounting are you doing, Martin? Good question. Let's go back to the class notes and have a little look at this. Just above the question, you can see I was using yellow earlier, and I was highlighting that there were two different forms of lease accounting. But it didn't feel right at that point to drill down into the details of this because it's quite conceptual, and it doesn't really, it's not a great way of starting lease accounting. It is better, I think, to get into bashing the numbers. So there's two different forms of lease, and the one that we were doing is called finance lease accounting, and it's to do with the examiner's view of risks and rewards. What you do, strictly speaking, when you are looking at lease accounting is, let's have us together as a team. You and I are leasing from, it would be nice if it was Sainsbury's just through the window there, through a leasing company just down the road on Fetter Lane. So you and I together as a team are in a company, and we are renting from some guy over my right shoulder. And I don't think I can go any further with this in a nebulous way. I want to get down to the question. And what I'm interested in is this 13 years. But the thing is that there are two 13 years. It's not immediately obvious, but the life of the contract and the life of the machine are both 13 years. And what we are required to do in this earlier test, this test up here, is to look at the rewards and work out who has them. Now, there's only 13 years of use, and you and I have 13 years. So the guy has got 0 years. Which is the bigger number, our 13 or his 0? His 0 or our 13? Our 13, obviously. So what we need to do is recognise the asset, but we haven't paid for the asset. So to keep the balance sheet balancing, we recognise the asset and corresponding finance. What is it called when you recognise finance? It's called finance lease accounting, and that is what we have been doing. All 4 of them are like that. So the life of the contract and the machine was 4 and 4 with no years with that guy, 7 and 7 with no years with that guy, and finally 5 with us and none with that guy for contract M. So there you go, that's the game. Finance lease accounting. All 4 of the above represent finance lease accounting. This is appropriate because in all 4 contracts let's be honest, the entire asset life lies with the user ABMN. ABMN is us, by the way. We are ABMN. And the final part of this question gives away its subject matter in the title. Question ABMN, Part 3. Which is operating lease accounting. Operating lease accounting. Let's get into it then. Here we go. Part 3. Right there at the top. Further investigation of contract N reveals that the machine life is more in the region of 50 years. Of course, this does not change the contract life of 13 years. So there are 50 years in the asset life now on investigation, which means that we still have 13, but the other guy's got 37. Which is the bigger figure? 37 or 13? 37, so it's his asset. So if it's his asset, we don't recognise the asset on our balance sheet. But if we don't recognise an asset, we don't recognise a liability either, and nothing goes to the balance sheet. But we're still paying that guy some money. If we're paying that guy some money, we have to recognise it somehow, and that cost goes to the P&L as an operating cost. How is it described when the only thing you have is an operating cost? It is described as operating lease accounting. So the revelation flips the nature of this lease into an operating lease. Investigation. This flips the accounting into an operating lease because now we learn that the majority of the asset life is with the owner, otherwise known as the lessor. How's that scanning? This flips the accounting into an operating lease because now we learn that the majority of the asset life is with the owner. Yep, that works really well. That works really well. And what I'm going to do is I'm going to focus on the thing that we don't do, because that really helps with a feature of this question. So nothing goes to the balance sheet. So nothing goes to the balance sheet. Only the following goes to the P&L. And as I mentioned, it is the operating cost. The operating cost is usually described as a rental. And it's just the cash flow that applies. This is contract N, by the way. So back to the schedule for contract N. What was formerly described, oh sorry, I've gone a bit far. What was formerly described as an instalment is now simply just a cash flow, and that 70 is a rental payment, is how we view it now. Like so. That was thousands, wasn't it? Yeah, thousands. Like so. But actually, the way that I want to explore this answer is by looking at this. Nothing goes to the balance sheet. The truth of the matter is that the whole story about the 50 years, the investigation itself and the 50 years could be lies. They could be obfuscation. They could be detail created in order to manipulate the FS. Manipulation. But the investigation could have been faked in order to flip a genuine blank lease into an apparent blank lease. Can you get those two the right way around? The creative accounting in theory could go in either direction, making a real operating lease look like a finance lease, or making a real finance lease look like an operating lease. It could go either way around, but it doesn't. It goes one way around in particular. It's the one that you saw up there. It's making a real finance lease look like an operating lease, making a genuine finance lease look like a apparent operating lease. And the motivator for this creative accounting is up there with the nothing. What goes to the balance sheet if we call a genuine finance lease an operating lease? If we call a genuine finance lease an operating lease, nothing goes to the balance sheet. But what if you're honest and call a genuine finance lease a finance lease? Well, in the contract of N in ABMN, a huge figure of 645 would go to the balance sheet. So what's the difference between recognising 0 and recognising 645? Of course, the difference is 645, and if you did that for 10 machines, even big organisations would start to feel it. And it's I was going to say almost always, but probably always related to noodling about with gearing, especially if gearing is just above some dangerous threshold. The classic threshold is 50%. So if in the draft FS you and I as creative accountants see a gearing of 51, which is just above our threshold of 50, all we want to do is just bring it down to 49. Then what we can do is we can fake investigations about, say for example we've had 100 or even 1,000 leased items during the year. Then all we do is just pick our favourite 10 that are difficult to investigate and flip them out of finance lease accounting into operating lease accounting, and we'll take 6.5 million off the balance sheet in terms of liabilities, and that could easily take the gearing down from 51 down to 49. We're just trying to play at the margins here, and that creative accounting is wonderfully effective and horrendously easy for the creative accountant to do. And of course the IASB don't like that, so that's the problem. Creative accounting is easy, and the solution is stop it by forbidding operating lease accounting. And of course you know this already from our discussion of the current issue. IASB the IASB solution to this is to propose finance lease accounting only. Well, there you go, guys. There you go, guys. Good, some great stuff. Great. Really good stuff. Really good stuff. Excellent. So, a couple of comments up here. One of them is very nice. It describes the story that I was just describing there by using the classic phrase, which is this form of creative accounting described over my shoulder even has a name. It's so common. It's called off-balance sheet finance. It is in fact one form of off-balance sheet finance, but it's probably the most popular. And the next question is something you almost certainly won't get asked in the examination, which is what happens if the asset life is 50-50? So using the story of contract N, 13 years with me and 13 years with the other guy. Now, for commercial reasons, it is actually very, very rare to have this kind of thing happening. So that's the first thing to say. Commercial necessities tend to mean that either the lessor will shunt all the risks and rewards to us and tell us you're going to take all the risks and rewards, or I'm not going to deal with you. It can be a bit like that. Or they'll keep the majority to themselves and say, you can borrow this, but I'm going to keep all the risks and rewards. And to be honest with you, in most real life situations, you don't tend to get a 50-50 situation. So it happens very rarely in real life, but it does happen. It does happen when you get a kind of 50-50. 13 years with me, 13 years with the other guy. What does he do? What do I do? The whole point is we do what the heck we like, which is also not very good, is it? So lease accounting falls apart when we have a situation where you have this. And exactly what point, should it be like 13 and 12? What happens if there's, 13 and 10? Well, again, you just do what you like. So that the IAS just, as soon as you start to push this IAS a little bit, even a little bit, it falls apart. But although theoretically it could be examined, it has never ever been examined. So the examiner has had both operating leases and finance leases, and indeed quite common. The operating lease and lease accounting is quite common. He's always had very extreme extremes. Literally, 5 years with me of a 5-year life, none with the other guy. 13 years with me of a 13-year life, none with the other guy. Literally that extreme. Or, you can't quite get the zero kind of thing, but you might have, literally 2 years with me and 50 with him. Or 2 years with me and 17 with him. So pretty extreme in terms of, the life. So in theory, you could get this, sort of 13-13 thing, but it's never been examined. But if it was examined, it would be in a question 4, and part of your answer would be realising that, the IFRS falls apart at this point. So it is more evidence that the IFRS needs to change. What else do I need to say about that? Nothing, I don't think. But there is something up there, and that is Ahmed asks, what would be the entry to recognise the asset? If you need to ask that question, Ahmed, don't use double entry to communicate. If you need to ask that question, don't use double entry to communicate, especially on lease accounting, because the markers aren't expecting debits and credits. If you're really brilliant with debits and credits, then even Sal would recommend don't use debits and credits to communicate on leasing. But if you're brilliant with leases, maybe you can. It's going to be a bit weird for the markers, they're not expecting it. But if you need to ask, don't put it in. But the double entry is going all the way up to the top for contract A, because I feel like giving contract A a chance. Here we go, right up to the top. I'm just going to use a bit of pink, shocking pink. There we go, there's that fella of 800. Yes, Ahmed, you would recognise debit the asset with a cost of 100, credit the liability with an initial recognition of 800. So the balance sheet retains its balance. Okay. Would it be realistic to prohibit operating leases? Realistic. Interesting word. Realistic. That's an interesting word. There's another one related to realistic, which is real. It is going to happen. Therefore, it will be real. Would you say when it's real, it's realistic? Wonder what you're asking there. What a strange question. Do you mean Will it be a pain in the backside for companies to have to suddenly be honest about their obligations? The answer to that is yes. Do you mean is it realistic to be honest after years of lying? Interesting philosophical point. We've been lying to the world about our obligations, and now we're proposing to tell the truth, and we're going to have to manage that. Telling the truth after years of lying. It's going to be tricky, isn't it? But yeah, I think it'll be realistic when it becomes real, myself. What happens if you acquire the asset after the lease period and keep it for an extra 2 years? Well, that would depend on the question and how it was phrased and what was going on in the detail of the question. So you send me an email on that one, Abs, because it's not clear what exactly you're asking me there. So send me an email on that one. Sounds like you want to philosophise about something that you've seen at work, so you can ask me that on an email if you would. Yes, of course, Troy. Your company lies about its obligations all the time, and the reason it does so is that IFRS tells your company to lie. So your company is telling the truth by lying. It's all gets all mangled up in the crazy world of financial reporting. IAS 17 requires you to lie about your operating lease obligations. They are real, and IAS 17 says you must ignore them even though they're real. Madness. If we look at the history of this, you can start to understand why this crazy situation did come into existence in the 1970s. But it does look really, really odd in the year 2015. Yes, Swishy, it's standard practice to follow IAS 17. Everybody does operating lease accounting for their operating leases. You must do operating lease accounting for your operating leases, and you must push your real obligations off the balance sheet because the IFRS says you have to, so you have to. In order to show a true and fair view, you have to lie because IAS 17 says so. And we operate in, a semi-philosophical environment, but when it really comes down to it, we corporate reporters are required to work around the law, and our law is called IFRS, and the IFRS says that you must lie, so you lie. There you go. So you should have no problem if this comes up as question 4. Swishy, yes, it is possible that the way that your balance sheet will look because you have loads of leases and they're all operating leases, that your balance sheet will look radically more sickly than it did because actually you have far more obligations than you confess to. Yep, that seems almost inevitable. When the new IFRS comes through, goodness only knows, it was originally proposed 2003 or something like that. 2005 it was looking like it was going to happen, and then it never did. Possibly, Swishy. I won't even bother to read out the question. So there you go. If that comes up a question 4, you've got plenty to discuss. But it may not come up as question 4. It may be in question 2 or 3. And if it does come up in question 2 or 3, it could be just like the numbers over my shoulder here, or indeed distinguishing between an operating lease or a finance lease. But there's another related subject called sale and leaseback, which does come up occasionally, and therefore I want to have a look at it with you. So here we go. Let's have a look at sale and leaseback. Let's have a look at sale and leaseback. I think I will say this out loud, guys. You know when we just had this debit credit story, and we were recognising a liability of 800 in A and an asset of 800 in A. If finance lease accounting becomes compulsory, it will change your gearing ratio, but it will not turn your balance sheet negative. All these obligations coming onto the balance sheet will have corresponding assets at the top. So what will happen is balance sheets will grow. They will be more honest about their liabilities, but they'll also be more honest about their assets. You do have the right of access to those machines that you use. You use them every day, but you ignore your assets as well as your liabilities. The city is obviously, the stock exchanges of the world are obviously very keen on learning about your hidden obligations, but you also want to communicate your hidden assets. So what will happen is your balance sheet will grow, your gearing will go down. If you work out the numbers and play around with some ratios, you'll see that your gearing will go up and get worse. But even though your gearing goes up, actually your balance sheet will still be positive. You'll have exactly the same recognised on the top of the balance sheet as at the bottom of the balance sheet. There is a separation that happens once you get into it. But what will happen worldwide is balance sheets will get bigger. Companies will be more honest about their liabilities, but they'll also be more honest about their assets as well. Do bear that in mind. Sale and leaseback. There are two forms. And of course, they are sale and finance leaseback and sale and operating leaseback. And in our class notes here, we have 4 questions. And, in this infinite world of corporate reporting, in theory, all 4 of them could be examined. And they have all been examined. The one that is by far the most common is number 1, so of course we're going to do that. Number 2 does come up every now and again, so we'll do that one as well. Number 3 and 4, I would love to say to you, has never come up, but it's not true. These 2 have come up occasionally. They've actually come up twice in 20 years, which is definitely not never, is it? So they've come up twice in 20 years. But because of the relative infrequency, I'm going to suggest to you that either you relegate these to your back end of your homework, or maybe even depending on the amount of time that you've got, you actually relegate these off altogether. Bit of a difficult thing to do, but you've got limited time before the examination. You need to focus on the stuff that gets examined regularly, which is 1 and 2. So we're definitely going to have a good look at 1 and 2. So the question is called tabular, and from the top, here it goes. The above has had 4 sale and leaseback transactions during the year. They all relate to property. All 4 of these are recorded in the library. So if you want to do all 4 of these, you can go to the library and just press the button on chapter 9, and you will find tabular, and you can do all 4 with me. But here in the classroom, we're going to do the regular 2, the orange 2. The first involves a leaseback contract for 20 years on a warehouse to believed to have roughly the same duration. So the number of years of life of the asset is 20, and of those 20, we have all 20, therefore it is our lease. So the lease is a finance lease. Tabular. 1. 1 is a sale and finance leaseback. It tells me in the title. So I'm going to look at lives. The asset life and contract life. Oh, what was that? Told you this table was wobbly. the asset life and, what was I going to say? I've completely forgotten what I was going to say. Contract life. Are the same. Are the same. So this is a finance lease, or at least the lease component is a finance lease. So we sell the asset and risks and rewards go out, and then we finance lease it back. Combined. So the risks and rewards of the warehouse go out to the new owner during the sale. But then the same risks and rewards come straight back in. During the lease. So the asset that we're analysing in this story is the warehouse. Before we sign the sale and leaseback contract, we have 20 years of use of this asset. After we sign the sale and leaseback contract, we have 20 years of use of the building. Nothing has happened to our relationship with the building. Before we had 20 years, after we have 20 years, it's still our building. But cash has flowed in, and the cash has to be something. Let's go and have a look at the question. The cash is described as being sale proceeds. This 30 is described as being sale proceeds. But just because it's described as being sale proceeds doesn't make it true. Conclusion. This fake sale is actually a loan. And although I'm not a massive fan of double entry as a mode of communication, I'll go for it here. So we debit the bank with the 30 and we credit loan. And as you can see, the double entry for this simple loan is extremely simple. It's not the double entry, the accounting that's difficult, it's the substance behind it. And wading our way through all the complexity of the language, of the way that the contract is being constructed. It is just a loan. A is just a loan. It's just a loan. That's all it is, a loan. But it's written in this complex language, and that's where we get our marks from pulling apart the complex language and realising that behind all this nonsense it's just a loan. But the other one is kind of used as a double bluff. The other one being sale and operating leaseback. Sale at fair value and operating leaseback. What we're going to do with this one is the same as we did with the other one. We're going to start by analysing lives. And the narrative about the lives is pretty similar to what you'd expect in the exam. I'll get rid of all that colour because it's very distracting, isn't it? Going back up to the top, the above company has had 4 sale and leaseback transactions during the year, of which we're going to do 2 here in the classroom and 2 are in the library. They all relate to property. The first involves a leaseback contract for 20 years and we're believed to have roughly the same duration. And we've done that one, we've shown that to be actually a loan. The other 3 involve short contracts of only 5 years on properties known to have a life of much longer. It's annoying that we're not told how many years. You know, it'd be nice to be told a total of 100, of which we have 5 and the other guy has 95. That would be a lot nicer, but it just isn't like that. So we're just going to have to work with this information and conclude that this is an operating lease. Lives. The contract is for 5 years, but the asset life is much longer. So this is an operating lease. So it's a sale and operating lease because it's a dual component transaction. So combined. The sale is just a sale. The risks and rewards of the property are transferred to the new owner during the sale who keeps those risks and rewards during the operating lease. Watch for the double bluff here. Watch for the double bluff. Conclusion. So this sale is in fact a sale. Do you see that? So the examiner thinks he can catch you out with a sale and operating leaseback. A sale and operating leaseback is a sale that looks like a sale but is in fact a sale. It's exactly what it looks like, and there's a kind of double bluff there. And the examiner knows that, when you see a sale and leaseback, you're trying to look for a sale and finance leaseback because that's the usual. But if it's a sale and finance leaseback, it is a loan. But if it's a sale and operating leaseback, it's what it looks like. It is a sale. So if it's a sale, the double entry would be like this. Like I say, I'm not a massive fan of double entry, but I think it works really well in this case. So we debit the bank with the cash inflow, which is a figure of 50 in part 2, and we credit a disposal T account with the cash as sale proceeds, described as sale proceeds, also 50. We then de-recognise the asset out of PPE at its exit carrying value of 42 and chuck that exit carrying value into the disposal T account. exit carrying value, or MBV, or whatever you want to call it. And then of course, to finish the fella off, we bring those two together to give us a profit on disposal of 8 million. There we go. It's good stuff, isn't it? So yes, sale and leaseback. Given that we have quarterly examinations now once a year, most of the time probably a finance lease, but every now and again an operating lease, just to kind of twist with our heads. Okay. How many marks would this be worth? Well, you probably you wouldn't get both in the same question. It has happened actually. You do sometimes get both in the same question, but if assuming that you just have one, how many marks have I earned myself? That's a good question. Oh, gone the wrong way, sorry. I'll go and have a look at my own answer and see. I think it's 3. My answer is looking like a 3 marker. Just give me another second. Just go back out again. Yes, it's a 3 marker. So that answer that you see over my shoulder there is 3 marks, precisely because it's got 3 ideas in there. So that would be 3 marks, which would be about right. So you wouldn't literally have a 3 marker on sale and leaseback, but you'd have a 7 marker where the main theme is sale and leaseback, but there could be, related party transactions, there could be prior period adjustment, there could be something else going on in there as well. So the leasing part there would be answered in full like this. Good stuff, guys. Just check how we're doing with the chat there. That's not working. So which mouse am I supposed to use? Am I supposed to use this one? What am I doing here? I was just thinking, okay, over there. Hey, bar. Well, are you going to work? Oh, hello. Yeah, okay, that's how that's working. All right. Just checking there's no chat that's disappeared off the back there. Everything seems to be fine. Smashing, guys. Wonderful. We're finished with leases. Good. Let's do pensions. I'm going to rule off now. Pensions time. So what I'm going to do is fabulous question, contact details on page 142. It's got 1, 2, 3 years, and by doing so I will have the opportunity to use repetition to reinforce the ideas, and then I will recommend the question glossary to you as homework. Here I go. There is tabula, goodbye tabula. Here's our main pensions question. Coming up, there it is, contact details. I'll bring up the title. And just down below, or on the next page, is the fabulous question glossary. If you look at glossary, this is really, to be honest with you, how a typical pensions question looks. You can see that there's just one column of numbers. That is just for 1 year. And if we take ourselves back to the question contact details, which we're about to do now, you can see that we've got 1, 2, 3 years. You are not going to get 3 years in one examination question. But it is a process. Pensions accounting benefits from repetition, so we're going to do pensions accounting 3 times. The question glossary is wonderful. Part A is where the money lies. But to be on the safe side, what I've done is I've also put in some of the dark corners of lease accounting there. If you really want to go into, the dark corners of pensions accounting, if you believe you have time and you have the brain cells and the time to go into the dark corners of pensions accounting, you have the opportunity to go into the dark corners of pensions accounting. They're in B and C. But just to reinforce what I was saying earlier, what I really want for you is to make sure you can do A, because it's A that comes. B has been examined once, C has been examined once, so they do get examined, but A is really where the action takes place. And it's really good homework question, lovely homework question. Answer in the back as usual, fabulous. Okay, let's get into it. So I'm going to get into this subject the same way I got into the other one, by using the introduction. There are in fact two forms of pensions accounting, lots of twos in financial reporting, and there's two forms of pensions accounting. They're called defined contribution pension scheme and defined benefit pension scheme, and they're quite literal. One of them, we as a company employ our employees and we define how much contribution they get, and on the other one we employ our employees but we promise them a benefit at the end. Now, if we promise our employees a benefit at the end, we have to save up to make sure that they're going to get their benefit, which means that we have to run an asset and we face all the risks. And because we face all the risks and also the management process of managing the asset, defined benefit pension schemes are very rare these days. They're not offered. They are offered in the United Kingdom only rarely, and generally only in public service offices, and even then, you know, many government departments don't have the opportunity to offer defined benefit to their employees. They're pretty much limited to the United States, to be honest with you now. So defined benefit is still relatively widespread in the United States, but even there it's rare. It's rare. It's all defined contribution. You know what I'm going to say now, because the only thing that's relevant in real life, we end up examining the other one. We end up looking at the other one. So a defined contribution scheme is where we push the risk down to the employee and we tell that employee, sort yourself out, and we just pay them, you know, an appropriate amount per year. So we might pay them £2,000 into their pension and they can sort out how they're going to invest it. So that £2,000 is the definition of our contribution. And we just make that contribution, game over. Now, wherever his salary goes on the P&L, whether it's cost of sales, admin or distribution, the £2,000 just follows, it just goes to the same place. So if we're talking about, I don't know, like a football team with a physio, and we pay him, say, 58 grand in salary, and we pay him 2 grand in pension, then 60 grand would go to cost of sales. And that's it. That's the subject done. So the one where we earn our money is in defined benefit. Here we go. Oh, sorry. Just dropped my pen. Give me a second. Oh, my bones are aching. There we go. Good. So defined benefit pensions accounting is illustrated by question contact details. And contact details is called contact details to remind me to give you my contact details. Slightly crazy, this idea, when I give you my contact details at the beginning of every session and at the end of every session as well. But there you go, just to reinforce that idea. There is my contact details. I seem to like the word reinforce today. It's a great word, I must admit. So we're going to do year 1, year 2 and year 3 together, not in the expectation that we're going to get 3 years, but in the expectation we're going to get 1, and the more we practice, the better we get. I should have said this before, I wish I'd said it earlier, but I'll say it now. You need fresh, new, brand new page. A full page for this fella makes a big difference because it all fits on one page and you don't want to be flicking about. So fresh, new, brand new page, fresh, new, brand new page. Here we go. The story starts with an asset which has an opening balance and an expected return. Then cash goes into the asset called contributions in. And then some of the employees retire, called benefits out. I'll just line up some sausages there. There we go. And the combination of those four items gives us accountants an expected closing. But we have a professional working for us in pensions called an actuary. And the actuary gives us a different figure. And this results in an actuarial remeasurement. An actual closing. And that's it. That's how you do the asset. There's an asset and a liability. Where we have an opening balance. The liability is discounted down to its present value, so then it unwinds. We have an unwinding cost. And then it gets bigger because people do some work for us for the year. That's known as the service cost. And then they retire and we pay them off so we don't owe them anymore. That's called benefits out. Gives us four numbers, and when we add down, we accountants find out the expected closing. But then that fails to agree to the actual closing because the actuary gives us a different figure, giving an actuarial remeasurement. And an actual closing. Then in the P&L, we have an operating cost, which is just the service cost. And we have a financing item, which is the net pension finance. Which is the net pension finance. Tricky one this, because it is the difference between two figures. Square brackets, I think. It's the difference between the expected return and the unwinding cost. Bit of a challenge to get this in with my chunky pen. I think I've just about managed that. I have to move numbers up a little bit. And then in the OCI, I have the net pension, no, net. Actually, I don't want to use the word net. You can, but I'm just going to go for actuarial measurement. I'll tell you why in a second. And then finally on the balance sheet, I do want to use the word net. We're going to have a net pension asset or liability. And you can see it just about fits on one page. And just let me see if I can line this up a bit better. By using this, just going to move things across a little bit. Yeah, I can do that really easily. Whoops, I don't need to do that by doing this. Yeah, that will work well. So just move that up a little bit, like that. Looks very scrappy actually at the scale, but that's okay. Just have a bit more space. Yeah, that's looking nice. Finally over there. There we go. Nice. And I don't want to forget my sausages. There we go. And there we go. There we go. It's a heck of a pro forma, isn't it? Can you even see it at that scale? It is just about visible. I can see what you can see there on a reasonable presentation like that. Great. Okay, let's get started. So, what do I do here? I change the scale and get started. Here's the question, starting with the asset. Here's the question, starting with the asset. Here's the question, starting with the asset. The following information is given about a funded defined pension plan given to employees by the above company who operate in the dating agency industry. To keep computations simple, all the transactions are assumed to occur at the year end. The present value of the obligation was $990 and the market value of the plan assets was $1,000 at the 1st of January year 1. Actuarial gains and losses are to be recognised as they occur outside the profit or loss in other comprehensive income. Now, to help me to recall these two figures, I'm going to drop them in straight away, both at the same time. So the opening asset was 1,000. Actually, I'm going to change colour to make this stand out. In the exam, just stay in black. But the opening asset was 1,000, the opening liability was 990. Just make sure I've got those two the right way around. Obligation 990, asset 1,000. Yep, indeed, there we go. And we're off. And then we go back to the question, and of course, for year 1, we focus our thoughts on year 1. Oh, strange. And of course, for year 1, we focus our thoughts on year 1 here. And we start with something very odd right at the bottom, which is this. It's the expected rate of return on plan assets at the start of the year. When this IFRS was originally written, we did the most logical thing, was that we used the expected rate of return as the expected return. We used the 12% for the expected return. We used to do that, but there was so much creative accounting in the use of expected return that the IFRS changed recently, and now you are forbidden from using the expected rate of return at all. Now, of course, you can see that in my question I've highlighted this by saying ignore this. But of course your examiner's not going to say ignore this. He may well give you the figure, but it is for you to ignore it. So we are going to literally ignore that line. We're going to ignore that line the whole way through. For us, it doesn't exist. So if we're not going to get the expected return from the expected rate of return, where are we going to get it from? We're going to get it from a counterintuitive place. We're going to get it from the discount rate. Now, the discount rate is used for unwinding the liability. The liability is discounted and we unwind the liability at the discount rate, which is perfectly consistent. What makes no sense is using the discount rate as the expected rate of return. It is not intended to make sense. It is intended to be difficult to manipulate. So the IFRS says we do this not because it's a good idea, but because people were messing with the expected return rate, because it's the law. Because it's the law. We use the 10% because it's the law. It makes the numbers easy then. 10% of 1,000 gives us 100. It is in fact the only area of this flow that is tricky. Contributions in are 90 and benefits out are 150, like so. And then we add down to find out what we're expecting. What we're expecting is 1040, 1040. But what we actually get when we look at the table of numbers, can you see, is 1190. 1190, giving us an actuary measurement of 150. And this positive balance is indeed a gain. And then we use the same kind of ideas on the liability. So the liability unwinds at the discount rate of 10%, giving us 99. And the service cost is 130. Copying it from the question. Benefits out, we repeat that information, 150, and then we add down to get, how do we do that? 1069, we get 1069. But that isn't what the actuary tells us. The actuary gives us a figure of 1100. Can you see that in the table? 1100, and therefore we get a difference of 31. Have I done that right? Yep. And even though that 31 is a positive number, the thing that's getting bigger is the liability, which is bad news. So what we do is we bring our bad news together with good news like this. We pick up the 150, we pick up the 31, and we stick both of them in the OCI. Both of them go to the OCI like so. So we've got 150 minus 31 gives us 119. And our answer continues like that. We consolidate the information. The service cost is 130. There's no trickery there. But there is a bit of trickery with the net pension finance. With that, in fact, I might benefit from changing the scale slightly and continuing to use colours. It's the second fella in each line. So it's 199. Can you see that? And you bring that together for the yellow fella there. So I'll just do that. It's a bit small, but I'll go in a second. So it's 100 minus 99 gives me 1. And I will go in for that because that looks a bit ridiculously small. So here we go, me going in. There we go, it's 100 minus 99 gives me 1 there. Then the net pension liability, I mean, I suppose this is completely obvious, but rather than just leave it like that, I will actually highlight it. All we do is take the liability, the closing liability, is that the asset? Closing asset and the closing liability and bring them together. The closing asset and the closing liability and bring them together. So that would be 1190 minus 1100 gives me 90. And there you go. And that's how it's done. But it's a real process, isn't it? It's a real process. It takes a bit of getting used to. You might need to practice this question a couple of times before you get into it. So, well, let's do a couple of times now on the right-hand side. So moving to the right-hand side, the start of the current year is the end of last year, so I bring this fella up, 1190. And then I multiply by, oh, I'll tell you what, when you go to the second year, make sure you go to the second year, as in you go to the second year, so the data for the second year. So we want to focus on the data of the second year. Discount rate is 9% now. So 1190 times 0.09 gives about 107, roughly. So 107. We then copy the contributions in, which is 100. Copy the benefits paid, which is 180. And then we add down. And we get 1217, which we compare to the actual asset, which is 1372. Get 155 as a gain in the asset. like that. Same sort of thing with the liability. Bring that up now, there we go. So the 1100. 9% again, so 99. Service cost 140. And benefits out we repeat, which is 180. Then we add down to 1199 plus 140 minus 180 gives 1159. The actual closing is 1380. Massive jump in the liability. 221. That huge jump in the liability gives us a loss in OCI. So we go to the OCI where we find we have 155 minus 221. Big loss of 66. And we collect the other information. 140. And then what was the two figures? It was 107 for the expected return and 99 for the unwinding cost, and therefore a difference of 8. And the net pension asset stroke liability, you can copy for the question actually, is 1372 minus 1380. So minus 8, like so. Yep, minus 8. And we just do one more year just to reinforce what we've learnt so far. Up to the top, do the same swizzle. 1372, this time 8%. 1372 times by 0.08 equals 110, roughly speaking. The contributions in are also 110. The benefits out are 190, sorry. So what's that? 210 add 30, so 1402. And the actual asset is 1188. That is a horrible, horrible drop. 1402 minus 1188 gives us 214, and it's quite clearly a loss. But this last column has value because it is tricky. And we'll go and do the liability together now. So bringing up the 1380, we have 1380, 8%, 1380 times 0.08 gives roughly 110 again. The service cost was 150. The benefits out is 190. So how do I do that? Is that 260, 70, 1450? So we're expecting a liability of 1450, but we don't get that. We get 1408. It's a drop in the liability. And this drop in the liability, you know, we do give it the old sausage there because it is a decrease in the thing. But the thing that is decreasing is a liability, and it is good for a liability to decrease. So that's a gain, which is a bit of a tricky fella, isn't it? So when we go into the OCI, we bring together a loss and a gain. So a loss of 214 and a gain of 42. So a loss of 214 plus a gain of 42. 172 is a loss, like that. Service cost is 150. And the net pension finance is almost exactly 0, not quite. It's 110 minus 110 as it goes in this case. Did I get that right? Yeah, it's the 210s. I'll use the yellow again there just to reinforce what I'm doing there. 110 and 110. It's a bit annoying. There's 310s, but it's the second number in each there. 110, 110 gives us 0, bar the rounding, it's not quite 0. And the net pension asset stroke liability is 1188 minus 1408. So 1188 minus 1408 is 220 is the net liability. And there you go. Great. And you can see that's going to need to be drilled. It is a process that you just drill. That presentation is called the gross presentation, and there is an alternative presentation which I'm a big fan of. It is the net presentation, and I'll show you how that works. Net presentation. I'll bring that little title up now. How's that work? Well, it doesn't look too bad actually. I'll bring that right up though. Net presentation. That's called the gross that we've just done so far. Here comes the net. There is an alternative presentation. I spelled that right? Presentation, yes. Which I'll just do for year 1 because there isn't really space to do it for all 3. But what you do is you just start at the beginning of the year with your net asset stroke liability. Do you remember the figures were at the top? For year 1 they were actually above the table. So we started out with an asset of 1,000 and a liability of 990, and we had a net of 10, and then you go straight to the net pension finance, which is then you use the discount rate. You do use the discount rate. It's 10% of 10 immediately gives you 1, which is nice, isn't it? And then things get a bit tricky because you have to pick up that the contributions go into the asset and make the asset grow, and therefore the net asset will grow by 90. And then the service cost doesn't go into the asset at all. It makes the liability grow. But if you make the liability grow, you make the net asset shrink. 130. Sausage. And then the hardest of all is dealing with the benefits. The only way I can do this, I think, is just to take a break from this for a second and go up there and have a look. Come out and go up there and have a look. It might have felt quite natural to do this while you were doing the number bashing process up here, but I don't know what colour I've got left here. Let's go for the funky blue. Can you see that the benefit out makes the asset shrink and the liability shrink? But that's what happens when you pay off a supplier. When you pay off a supplier, your assets shrink and your liabilities shrink. Your liabilities shrink because you pay off the supplier, you don't owe them anymore, and your asset shrinks because you have less cash. And that's what happens. But what effect does paying off a supplier have on your net assets? Well, you have less assets and less liabilities, but the thing that you have in both is the same, and therefore your net assets are unaffected. So you have to remember that when you're doing the net presentation, you ignore the benefits paid, which is a bit tricky, isn't it? So coming back into our answer, that's the end, and that's the expected balance. And I'll go back in again now. It's not very easy working on that scale. And we get 40 minus 29, and then we need the actual closing, which is the obligation is that, and the asset is that, right? So 11 90 minus 1100 gives me 90. And then, you know, you have to realise that when you go up from minus 29 through 0 up to plus 100, you have a gain of 119, and that is the actuarial remeasurement. And that goes into the OCI, of course. Now, that's a balancing figure as well. And either of these presentations is acceptable, except in one circumstance. If the examiner asks you for the gross, then you have to give the asset and the liability and then the effect on the FS. And he does do that occasionally. I haven't seen him do it frequently recently. But on the other hand, you know, when he gives numbers in his question, it could be answered either with the net or with the gross or the net. It doesn't matter. The examiner seems to have a slight leaning towards the gross, and perhaps academically the gross is slightly better, because what there really is an asset and a liability, and not a net asset. There isn't a net asset. There is an asset and a liability, and not a net asset. And so I suppose academically maybe the gross presentation is academically preferable, but personally I prefer the net. But you use whichever one you want to. What I tend to find myself, what students tend to tell me, is the net is quicker, but it takes more thinking. The examiner is not entirely consistent about the number of marks that is available for just one year, but somewhere in the region of 5 or 7. 7 last time it was examined in this depth, but I have a feeling he might shave a little off if it came up in 2015. So for what we have over the board, probably around about 5 marks, I think. It's okay, I suppose, if you're well drilled. Good. Which brings us to share-based payment. So let's have a look at share-based payment. Share-based payment. SBP. And in order to get our heads around this, we need to be able to do one of the questions. Is share-based payment the heading? Does it make you drunk seeing all this go past you? Does look weird, doesn't it? This is the question, and it's on page 148. And if you have a look at it, you will see that it has both of the fellas that we need to talk about, options and SARS. And that's the question for us. The question's called Bilberry. There's a baby question just above, as you can see, called benign, which is very benign, it's very gentle. And of course that's recorded into the library. And if you want to, reinforce Bilberry, then please feel free to do benign. But really the homework question is the next question, which I'll just get with page down. There you go, there's Beth. Beth is really nice. So your homework question from SBP is Beth. Beth is great. And it's about right, 4 marks on SBP these days. It's about right. The subject hasn't gone off the syllabus altogether. No, that would be a massive exaggeration, but less frequently examined and around about this sort of standard. You can see that there are other questions to drill SBP, like easy peasy and sneaky, and they look at other stuff within SBP, but Beth is where it's really at. That's your main homework question. But our question for now is this question, Bilberry. and it derives from the notes just above. So let's have a look at the notes just above. Now, SBP is rather cute. It's based on measuring a cost by measuring an obligation at two different measurement points. One is the year end and the other is the year start. And what we do is we measure an obligation at these 2 points based on a mathematical equation. The obligation is measured as this number multiplied by this number multiplied by that number. Now, they all sound quite alien, so let's just go from right to left. They're not really that easy, to be honest with you, but somehow when we come to do the questions, they're not quite as bad as they sound. The timing ratio, first of all, let's tick that off. The timing ratio is the idea that when you're at the end of year 1 of a 3-year scheme, you're at the 1/3 point. The fair value should really just be simply the fair value of the thing that you're giving to the employee. The employee has an asset and you have an obligation, and their fair value is your fair value. But unfortunately, it doesn't work out quite as simple as that. You have to learn the two names of SBP. They're called options, which is by far the most common, and the other one's called SARs. And depending on whether you have options or SARs, you'll use the grant fair value or the current fair value. Whoa, 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 that's really starting to get tricky. And the last thing is the number of rights expected to vest. Expected to vest, grant. Let's get into the language of SBP. Typically, SBP is for a 3-year scheme. It starts at the beginning, it ends at the end, and then the cash flows. My wife recently finished her share-based payment scheme. She finished on the Monday and she got her cash on the Thursday. But there is a short delay between, 4 days, between her scheme coming to the end and her getting the cash. And that gives rise to 3 words. The start, when she signed, was called the grant date. The start is the grant date. The end is called the vest date, and that's when she has fulfilled the criteria of her scheme, which would just be a period of loyalty, usually 3 years. But what we don't do is we don't automatically give our cash to our employees in case they haven't fulfilled the criteria. What we do is we spend a couple of days figuring out in the background if they have fulfilled their criteria, and if they have, then we give them the cash. But because we need a couple of days or maybe 4 days, there is a short delay between the vest date and the cash flow date. The cash flow date is called the exercise date. So it's grant at the beginning, vest at the end, and cash flow is exercise. Grant, vest, exercise are the 3 words. Now, the number of rights expected to vest is essentially the number of people in the scheme that we're expecting to be there at the end. And we measure this obligation at each measurement point. And it is starting to sound a bit cumbersome. But somehow it doesn't work out quite as bad as that when we bash the numbers. So let's do this question benign. No, my apologies, Bilberry. Let's do this question Bilberry. Bilberry comes in 2 flavours. Flavour 1 is options. And as you can see, it says at the top, Bilberry offered a 3-year share-based payment scheme to its directors. The volume granted was 20 million. That means there are 4 points. The measurement points are the start, year end 1, year end 2, and year end 3. And in between there is an operating cost. For each of the 3 years. In every case, the operating cost is worked out as a balancing figure. And in every case, the measurement point is calculated by multiplying 3 numbers together, giving us quite a nice look to this movement. in the liability. Oh, I've been looking at that clock, whereas this one says something completely different. I do apologise, guys. I've just looked down at that clock there. This one up there says 20 past, and I was aiming for that. So my apologies, guys. We're going to run over slightly because the clock just over there says 20 past, and I can now see it's 28 minutes past there. So looks like we're going to run over by 8 minutes. Sorry about that, guys. I should be looking at the wrong clock. I won't make that mistake next week. The first question we ask is how many years are there in 3 years? And the answer is 3 years in 3 years. And then we count to 3, including 0. And you can see what I'm doing. I'm starting on the right hand side. I find it easier starting on the right hand side. When we have options, we use the grant fair value. And now we know that the grant fair value is the start fair value. This is counterintuitive, I think. You might even say wrong, but the IFRS does say that we use the 20 cents and then we reuse it over and over again. It really does say that in the IFRS. This is a bit crazy, isn't it? But then, you know, IFRS often are crazy. And then the great thing is the number of rights expected to vest, we just copy. And then we multiply, so 17 times by 0.2. Oh, silly me. 0. 18 times by 0.2 times 1 divided by 3 gives 1.2. 15 times by 0.2 times 2 divided by 3 gives us 2. And 16 times by 0.2 equals 3.2. And therefore the cost in the first year as a balancing figure is 1.2, cost in the second year is 0.8, and the cost in the third year is 1.2 as a balancing figure. But I have to be honest with you, there is one supplementary bit of this question that flows off the back end, and that is, where does this information go? Well, I'm not going to be surprising anyone to tell you that the operating cost goes in operating costs. All of them, each of them goes in operating costs. What will be a surprise to some of you is that this fella here, this obligation, goes into equity. You and me were in the company and we have given options to our directors. Now the director, if you want to be a director for a second, he's getting richer and richer as this process is happening, and as this process is happening he has an asset. But an asset is just an asset. We're on the other side, we've got the obligation. If you think about the bottom of the balance sheet, it's got two sections, hasn't it? It's got equity and it's got liabilities. It's got liabilities and it's got equity, and the obligations could go in either place. So what do we give to the director when he comes to us at the end? Ha! Trick question. We give him nothing when he comes to us at the end, because that's when it vests. But a few days later, when we've checked that he's fulfilled his contract, we then give him shares. We give him equity. And if this obligation is settled in equity, then we give the guy equity. But while he's holding his options, he's not a shareholder, okay? He will become a shareholder once he becomes a shareholder, but just at the moment he's an option holder. So if he's an option holder, this goes into other components of equity. And by that I mean, you know, not just the 3.2, but each of them, even the 0 starts out there. So maybe I'm overcooking it by saying this, but the 0 starts there, and then the OCE grows and it grows and it grows till it's that figure. Okay, so the OCE starts at 0 and then it grows and grows and grows. But you could have SARS. If you had SARS, how would the answer change? Well, of course, that's Bilberry Part 2. So question Bilberry part 2. Let's do that together. Now, share appreciation rights are essentially exactly the same as options, but we pay the employees in cash. They're actually very rarely offered. I have tried to research SARs with not an enormous amount of success, but as far as I can work out, they only exist in 2 organisations in the entire world. One of them is through there, it's Sainsbury's, and the other is Sainsbury's competitor, which is Tesco's. So how about this for specialist accounting? You're learning about motivation in Sainsbury's and Tesco's. That really is specialist knowledge, isn't it? Now the question is exactly the same, except that the middle changes. The question is exactly the same, except the middle changes. Timing ratio is the same. Our expectations about number of rights vesting is the same. But when we are doing, it's been unfortunate, I've split a page here. I'm just going to have to take it up a little bit. I apologise for that. Just give me a second. When we're doing SARs, we're doing SARs. And when we're doing SARs, the rules say that you have to use the current fair value. I'll just bring that up again and then annoy you again by flipping off. So I'm going to flip off and have a look at, can you see this down here? You just have to learn that when you're doing, oh sorry, that's not what I meant to do. When you're doing SARs, you have to use the current fair value. It is the logical one, but it is a bit annoying. You have to remember this detail. So, okay, we've remembered that. So now what we do is we do the logical thing. Makes the numbers a bit harder work, but it is much more logical. We use the 20 cents when the thing's worth 20 cents. We use 27 when it's worth 27. We use 33 when it's worth 33. And we use 29 when it's worth 29. Much more sensible. Oh, done it again, can you believe it? Worked out that 0. Oh, that didn't work. $1.62. $3.3. Oh, what happened there? That was weird. There we go, 4.64. You can tell how good I am with the calculator. So 1.62, 8, 3, add 3 is 6, so that would be 1.68, and that's 4, 3, 1.34. And where does the operating cost go? The operating cost goes into operating costs. But where does the 4.64 go? Indeed, where do all of these fellas go at the bottom here? Look at this cheeky little fella. It goes into liabilities, because the 4.64 will be paid off by using cash. The SBP will be paid off by using cash. And this form of motivation is used with small cash flows to the junior members of staff. So in fact, Sainsbury's across the road does have options for the senior members of staff with high volumes of SBP. They have high volumes of options. But the junior staff, where there's lots of staff, each have small numbers of SARs. But those guys across the road, when they come to ask for their cash, they'll be told the usual, just wait, and then they'll wait their 4 days, and then they'll get their cash. And when they get their cash, they get their cash in cash. And because their cash is paid to them in cash, they're just a normal liability. Same as the taxman, same as the suppliers of bread, same as the distributors. You know, they're just a regular supplier paid off in cash. So just to really reinforce this balance of zero starts in liabilities, it grows, it grows, it grows, and then it gets paid off and it drops to zero. Well done, guys. I told you I was going to run over there. Unfortunately, I was looking at the wrong clock. I'm absolutely bang on time according to that clock, but not according to this one. So well done. We've managed to get through a lovely little session with, you know, some sort of. It's getting harder now, isn't it? But we're into the rocket science next time I see you, which is next Thursday, isn't it? And I will give you the usual, which is the goodbye slides. Is my little goodbye slides, reinforcing what I was saying earlier, which is have a look at that fabulous question glossary. The progress tests, they're all up on the platform. To be frank with you, you can have a look at all 4 of them. Progress test 1, progress test 2, progress test 3 and progress test 4. This slide is recommending that progress test 3 is ready for you now, but actually all 4 of them are ready for you and ready to go. And this tells you what you know, which is how to calculate the actuary measurement and calculate an SBP obligation. You certainly know those two. And looking forward, to session 8, the final session. Chapter 12? Where's chapter 13? Do you remember me talking about the way that I'm going to use the mentoring session? I've got my iPhone here with its diary in it, and I'll just reinforce the mentoring session date, which I've got down as being Friday the 13th. Oh my word, that sounds a bit scary, doesn't it? So we have our last session of live on Friday the 5th. Oh, that's, what would that be? That's Guy Fawkes night here in the UK, Bonfire night here in the UK. So on Bonfire night, we have our last live session next week where we're going to do financial instruments. But then we've got the mentoring session. Not the following Thursday, but the following Friday, actually. And that mentoring session on the following Friday, I'm going to be a bit cheeky. I'm going to chop it into half, and I'm going to give you 15 minutes of deferred tax. So chapter 13 is actually going to pop up in the mentoring session. Bit cheeky. And it sounds like I'm really squeezing it, but the truth of the matter is that financial instruments is where it's at these days, and a full evening on financial instruments is entirely appropriate. Deferred tax may not be in your exam at all, and if it is, it'll be 1 or 2 marks, so 15 minutes feels about right. So, there you go. I look forward to doing that stuff with you. I will see you next week when we'll do financial instruments. You've got plenty of homework to do now. Even making sure that you're keeping up with these questions is plenty to be getting on with. Have a wonderful weekend, and I will see you next week when we will continue our course, finish our course with financial instruments.